So Felipe is the managing partner of EquitasVC. This is a venture capital firm that is focused on pre-seed and seed investments with a hands-on approach focused on sales growth. Prior to EquitasVC, he worked in the investment banking division at Goldman Sachs, and he was a co-founder too of two startups. The first one was Beleza Web. This was a venture-backed startup by Tiger Global, and this one was acquired by Grupo Boticário. And he was also co-founder of CentralFit. This was a startup that bootstrapped and was acquired by Grupo MnW. So again, Felipe, thank you so much for your time, for your knowledge, for being with us in this super important night. We couldn't be happier, and well, the stage is yours.
Okay, thanks. Thanks so much, Luisa. I really hope that after these kind words, I'll be able to match the expectations, and I hope that this session will be useful for folks here listening. Okay, so let me start. The idea here is to have around 40-minute session and then a 20-minute Q&A. So I'll be very happy to answer all of your questions at the end. Let me try to share my screen here. Always a very dramatic moment. Let me see it work. Can you guys see my screen? Just do like this or like this.
We can see it.
Okay. Okay, so let's get started. So as Luisa mentioned, I used to work at finance at the beginning of my career. Then I co-founded two startups. I was in charge of financing both of those startups. And then I basically made a lot of mistakes. And the idea here is to try to talk a little bit about those mistakes so that you guys can make other mistakes, not the same ones that I made in my past in my past life as an entrepreneur. So let's start. Let me see if I can change slides. Okay, so the idea here, well, in theory, is to talk about the strong financial foundation, but actually that's kind of boring. So we'll talk like how not to let your company die because of finance. So it's basically a very practical approach on where you should look and what you should take into consideration, especially if you're not a founder with a financial background. So it's very tactical, and hopefully after the end of this, especially if you don't have any financial background, you'll be able to have at least some idea on where are the main problems, where you should focus your attention, what is the minimum that you should know to be able to focus on the other parts of your business, of growing your business, and not letting finance be a problem neither now nor in the future. Okay, so just to give you a little bit of feedback of, well, Luisa was already very kind to mention, but like my background is basically I used to work at Goldman Sachs, basically doing lots of PowerPoint during strange hours and not sleeping much. And then I left to co-found a company which was co-founded by Tiger and also Kazakh, called Beleza na Web. That company was a cosmetics retailer here in Brazil. It was sold to Boticário in 2019. Then I also co-founded a second company that was bootstrapped for 6 years, called CentralFit. It was also sold to a strategic group called MnW. Then I spent 1 year acting as a part-time CFO for 5 companies, actually, one per day. That was pre-COVID, so I was able to go every day to a different startup. Very funny, like very rich times in terms of knowledge, and also about learning of different business models and helping venture-backed CEOs to manage finances in their companies. And then since 2020, I'm the managing partner of EquitasVC, which is a early stage fund, which is very much focused on it's Brazil only, and it's focused on pre-seed and seed investments we have a very hands-on approach. I think given my background and also the rest of the team's background, and we like to partner and invest into technical co-founders who usually lack commercial skills, and then we try to help those guys to scale their sales so that they can grow the company based on their strong technical capabilities. So, okay, let's start. So here today, given that we are among LatAm co-founders, the Latitude marketing team stole my analogy here. So this is not going to be a new joke, but basically the way that I see a company, a startup is the following. So we have the marketing, the sales, the product teams. They are the stars. They are the ones who are scoring the goals. And the finance team is is the one who's defending, who's always trying to control stuff, and who's always in charge of not losing the match in terms of the defense. So you're probably not going to be able to win a game if you suffer too many goals. So the idea of finance is that defense is to avoid suffering goals, so that the stars of the startup, the marketing, the sales, the product teams, they are more able and more likely to achieve the victory. Okay, so that's the idea here. So basically my talk here is very quick and divided in 3 parts: the basics, the biggest problem of finance, and also some real life examples so that you guys can use on your endeavors in your companies for managing and running finance in the best way possible. Given, I think it's important to mention again, this is focused for founders who do not have a financial background. It's the basic stuff, but it's the basic stuff that's it's important to be mentioned and to be reinforced, because many big companies, many sometimes unicorns, they didn't build their structure from scratch, considering the basic stuff in finance, and then they have lots of problems when they grow. So let's start with the basics. So first, the idea here is to give you some theoretical concepts on finance that are very much important for you guys to understand what we'll be talking about. So let's start. So the bare minimum that you guys need to know to run your startups on the finance side. So basically, the first concept is the income statement. Here's an example of an income statement. It's basically a statement that starts with sales, like with gross sales, gross revenues. Also, the language here is very, there are lots of synonyms in finance. So sales is synonym to revenue. And then it goes down to net income or net loss. Also, it can a synonym can be net profit or also net earnings. So at least here in Brazil, sometimes people they think that revenue and earnings are the same. They're not. Revenues are the sales of the companies. Earnings is the last line of the income statement, which shows the profit or the loss, the earning of the period. So this is an income statement. Okay, what is important here? It's used for profitability analysis, EBITDA margin, and also contribution margin. We will go through these concepts in a while. Okay, so bear with me. It starts on revenues, it ends on net income. So it's important to have this in mind. The first line of the income statement is sales, and the last line is the net income. Okay. Sales, gross margins, EBITDA, net earnings, those are always found in the income statement. Okay. Okay. Second concept, cash flow statement. Cash flow statement is this. So basically, you start with net earnings, and then you go down up to cash flow. So basically, if you observe, like, the first line of the cash flow, which is net earnings, is the last line of the income statement. Okay, so the first line of the cash flow is the last line of the income statement. So it starts with net earnings, then we do some adjustments here. We'll go through the most important adjustments in a bit, and then you go to the cash flow. And the cash flow, it's basically the amount of the amount of money that changed in your bank account. So when you see that your bank account it went down by 1 million between 1 month and the following one, you had like a negative cash flow of 1 million. That information you see here on the cash flow statement. The last line of the cash flow is the delta, the variation of your bank account in a given period of time. Okay, also quite important concept. The third one, oh sorry, let's recap. So what is the cash flow used for? The runway analysis. So basically you see by looking at the cash flow how much money you're burning per month. Then you have an idea, given how much cash you have, you can divide that by the current burn or the projected burn, and then you have an idea of how many months you have before you run out of money. And this is very important for obvious reasons. You don't want to run out of money. Okay, so it starts on net earnings, ends on free cash flow, and all that information, cash burn, capex, debt repayment, it's all on the cash flow statement. Okay, at least here in Brazil, people, most startups, they're able to understand and to project and to control their finance on an income on just like creating and controlling the income statement, but it's very rare for startups to also control on cash flow statement and balance sheet, and that's a big mistake. So the idea here is to give you a grasp of the three statements so that you can understand how they connect and what's important for you to look at when you are trying to understand what they mean. So the last one is the balance sheet. So basically, this is an example of a very simple balance sheet. On your left, you always have your assets. On your right, you have your liabilities and your equity. So basically, the idea here is that the total assets, they equal the total liabilities plus your total equity. So basically, what does it mean? You have assets, stuff that you own. You have liabilities, stuff that you have to pay. And then when you subtract your assets minus your liabilities, you have what's left for the shareholder. That's the equity. Okay, so that's the concept of the balance sheet. So most used for what? For health of the business. You can if you know how to properly read a balance sheet, you have a good grasp, a good idea of how healthy or how unhealthy a business is. So assets on the left, liabilities plus equity on the right, and then cash position, total debt, operating working capital. This is always found on the balance sheet statement. And don't worry, we will go through those concepts, especially operating working capital, which is quite important, in a while. Okay, so those are the three basic statements for understanding a company from a financial standpoint. Okay, another very important concept is the difference between accrual and cash basis. So I've already tried to explain this concept in several ways. So the best way that I found is through two pictures. So basically, accrual basis or accrual accounting is that you record your income when you earn it, and you record an expense when you incur it. And then cash basis is you record income when you receive it, and you record an expense when you pay it. So this is very important. Let me try to give you an example so that you can maybe it becomes more clear. Let's say that I have a company that sells bottles of water. So that's my startup. I decided to sell bottles of water. So let's say that in this month, October of 2022, I sold 100 bottles for $100. Okay. However, my customers, they will pay me in 60 days. So I said to them, okay, you don't have to pay me right now, you can pay me in 60 days. Okay, so we are in October, they'll pay me in November. So in terms of accrual basis, I have to record my sales in October because that's when they happened. However, on cash basis, I will record my sale when I receive the money. That will only come into fruition in December. Okay, so this is a very important concept because we have the concept of accounts payables and accounts receivables, which is basically we buy something, but we don't have to pay upfront. It's very common for suppliers to give us some terms like you can pay me in 45 days, or you can pay me in three installments. And the same happens for sales, right? So you sell a product today, and then your customer, he pays with a credit card, and the credit card company will pay you in installments. So basically, whenever you book your sales in terms of when that happened, it's accrual basis. However, on a cash basis, it will only be accounted when you effectively receive or spend the money. Okay, so this is a very, very basic and very, very important concept. Why? Because companies, they go bankrupt on a cash basis, not on an accrual basis. And also, what's very important for you guys to understand is that income statement, it's always based on accrual basis. So you book the revenues, you book the expense when you incur them, when you make the sale, or when you incur the expense. However, the cash flow and the balance sheet, they always happen. They are always booked under cash basis. So that's effectively when the money comes in or goes out of your bank account. This is why the last line of the cash flow is quite important, because that's the amount of money that will change, like the delta in your bank account. So you see that in the cash flow statement, because the cash flow statement is under the cash basis, and then it's really how your bank account is affected. And companies, they go out of business when they don't have money on a cash basis on your bank account. So this is why just analyzing and projecting an income statement is insufficient to proper understand how your cash position evolves and will evolve in your startup. And this is a big mistake that many companies make when they're starting. And the best way is to start correctly, even if it's in a basic fashion, not very sophisticated, but it's good to start well with the right foot. So in the future, you are not scrambling and trying to understand what happened to your money that disappeared. Okay, and I talk this from experience. Okay, so hope it's not too heavy, but like, let's keep on. Another super important concept, contribution margin. So basically, contribution margin is the following: is the net revenues minus the variable costs minus plus the variable expenses. So basically, you want to get your net revenues, and then that's basically your sales minus your taxes on sales, and then subtract all your variable costs and expenses. And so why is this important, and what's the idea behind the concept of contribution margin? Basically, the contribution margin answers the following question: will you have a healthy business when your revenue is big enough? So basically, think about it. Like, let's say that I have a business that sells, again, water bottles. Okay, so I sell my water bottle for $1, and let's consider that I have to spend, like, the bottle cost me when I buy it from China 20 cents of $1, and then for shipping expenses I pay another 20 cents. So considering that those are my only variable costs and variable expenses, I'm not spending anything on marketing, I'm not spending anything else, my contribution margin in this case would be 60 cents, which would be $1 in the sales price, not considering tax on revenues for simplification, minus 20 cents of the costs, minus 20 cents for the freight. And what's the problem here? So with 60 cents, I cannot sustain a business. But if I sell 1 million bottles per month, I will have enough money to pay for payroll, for rental. Those are fixed costs, okay? So basically, contribution margin shows me how much money remains after I have covered all my variable costs. And so then I can dilute my fixed costs, which are fixed. They do not change if I sell more or less. I have to pay payroll every month. If I sell 100 or 0 bottles, I have to pay rental every month if I sell 100 or 0 bottles. So those are fixed costs. And the problem is, which happens a lot in startups, is that you start selling, you don't control your costs, your variable costs and your variable expenses. And then when you come into Sensis, you have a business that has negative contribution margin. And that's a big problem, because no matter how big your business becomes, you'll never be able to pay for your fixed costs and expenses. And it's really giving a step back here and going into reality. You may think, oh, this is stupid. Why would I do that? Like, why would I scale a business with negative contribution margin? It happens all the time for several reasons. For like, I want to occupy the market. I have pressure from my investors. I have to grow. I have to reach a milestone for raising the next round, etc., etc., etc. And the problem is, the later you try to adjust your contribution margin, which is probably the most important unit economic, the harder it is. It's basically trying to stop a locomotive, like a very big and heavy train. You need a runway, right? You don't have to. You cannot do it in a short distance. You have to let the train brake. Otherwise, you will break the rails and break the train. So it's really important for you guys to control contribution margin, understand your contribution margin, and question yourselves, okay, if I have negative contribution margin, is this a business that's worth scaling? Is this a sustainable business model? And then try to fix it and trying to find a way, or a customer segment, or another price point. I don't know. But the advisable stuff to do here is to try to figure out that before scaling your business, okay? Because after the fact is really hard. And this is one of the major causes that companies die because of finance. They are big businesses, they have growth, they have significant revenue, but they have a not sustainable business model. And when you mean by what I mean by not sustainable, unsustainable is a business with negative or very slim contribution margin. Okay, so hope you guys got this. 3 more concepts, I think. Basic concepts. LTV, it's basically the monthly or annual contribution margin per client divided by your monthly or annual churn. So this is a very classic metric together with CAC, which we'll talk about in a bit. A very important point here in terms of LTV calculation is the following. You should calculate your LTV not based on revenue, right? You should calculate on contribution margin. And the reason why some companies, they calculate LTV on revenue is because they are SaaS companies, they are software as a service models, and then they have almost zero marginal costs and marginal expenses. So this is why it's a proxy, because some digital products, they have zero marginal costs, but not all. So the correct way to calculate LTV is based on contribution margin, the concept that I just explained, not on revenue, okay? CAC is basically the total marketing expenditure plus the total sales expenditure divided by the number of new customers acquired on the period, okay? And then here, there are several different ways to calculate CAC. You can have what is called a fully diluted CAC, a non-fully diluted CAC, which is basically the difference between the two is that you either consider or not headcount, like people in the calculation, right? You have some concepts as well of what is a customer, right? So you have to divide by the number of customers. What is a customer? Like premium is a customer. Proof of concepts are those are customers. Free trial are those customers? Yes or no? You have to decide for your business model. Also, there's usually some time between spending money in marketing and converting the client. Sometimes you spend money today, and then you're going to be able to convert that customer in 2 or 3 months, especially for B2B companies, which have a longer sales cycle. So sometimes you have to adjust, right? You have to compare the number of new customers of a given month with the marketing expenditure that you made like 2 or 3 months ago. So this is another thing to be considered. And also include or not salaries and overhead. So there are several ways to calculate CAC. And the important point here, the message here is the following. The important stuff here is to be consistent over time. So if you decide a way to calculate your CAC, do not change it over time, because when you are showing your numbers, your figures to potential investor who's analyzing your company, if he starts drilling down, and like I'm a VC right now, so nowadays, so this is something that we do, like we try to understand how the company acquires customers, and then you can, with 2 or 3 questions, you can figure out if the founder is consistent or not. And it's a really bad sign if you're not consistent in terms of CAC calculation, because you can always tweak the numbers if they're not great in a given month to improve your CAC figures. But like a more diligent investor will ask the right questions, and then you lose all your credibility, right? So the right way to approach the situation is to be consistent on how you measure it, and do not change over time. So you are able to answer all the questions. You won't have any blind spots. Even if your numbers are not great, they're honest and they're true. They're truthful. So this is very important. So before starting to calculate CAC, define like what is a customer, what is the time lag, will I include or not salaries, and then after that keep that over time so that you can show your evolution. Okay, this is very, very important. So working capital. So basically, just giving a small pause here, if you guys have to understand one concept from my talk here today, please be this one. Working capital is really, really important. And it's something that for, I don't know why, but like at least here in Brazil, people do not know how to calculate. When you ask people like, what is working capital? The answers come like, wow, it's the amount of money that you need to run your business. And like, what does that mean, right? What's the formula? How do you calculate working capital? It's a number, so you have to calculate it. So how do you calculate working capital? This way. So what we call operating working capital is basically your accounts receivables plus your inventories minus your accounts payables. So remember those 3 accounts, like receivables, inventories, and payables, they're always found on the balance sheet. And I'll try my best to explain the simplest way that I can find what are those 3 concepts. So basically, remember, the difference between cash basis and accrual basis is that sometimes you make a sale and it takes time for your customer to pay you. And following the same logic, sometimes you buy stuff, you buy inventory, and your supplier, he gives you some weeks or some months for you to effectively wire the money, effectively pay for the purchase. So what is the concept here? So basically, accounts receivables, it's everything that you sold but did not yet receive in your bank account. So let me give you an example. I sold this month 100 bottles of 100 water bottles for $100, and I will receive them in 2 months. So at the end of October, I have $100 in accounts receivable. I have already sold them, but did not yet receive the money in my bank account. In November, let's say that I sell 50 bottles for $1 each, and I will receive in 2 months. So at that moment, at the end of November, I will have $150 in accounts receivable. I will have the 100 that I sold in October that I'm going to receive in December, and then I'll have additionally the 50 that I sold in November that I'm going to receive in January. And then let's say that during December, I sell no bottles. At the end of December, my accounts receivable will be of $50 because I will have already received all the money that I sold in October, the 100, but I still have to receive the 50 that I sold in November. This is really important, guys, because we usually sell stuff either in installments, either with payment terms, and then you receive, but you did not yet receive the money in your bank account. So you have to consider and know how much your accounts receivable position is. Same logic happens for accounts payables. It's basically stuff that you bought but did not yet pay, especially at the end of months, because you usually do monthly balance sheets. And this concept of operating working capital is fundamental, is instrumental for you guys to be able to calculate your cash flow, not only your profit or loss. Okay, so it's really important. So basically, operating working capital, it's accounts receivable, the concept that I just explained for your sales, plus your inventory, how much you have in your inventory in terms of cost. Like I have 100 bottles, they cost me 20 cents each, right? So I have $20 in inventory in that example, minus your accounts payables. It's basically how much you already bought but did not yet pay, following the same logic of accounts receivable. So that formula shows how much you have in operating working capital, and that is super important. Okay, we'll wrap up that shortly, but if you have to understand one concept from my talk, please be this one, and you'll be probably already above 95% of the founders here in Brazil, at least, who do not have a financial background. So basically, think about it, like when this number goes up, your bank account suffers. Okay. Okay, moving on. Last concept here, I think, burn multiple. So this is mostly for SaaS companies. Basically, is your net burn divided by your net new ARR. So and this is a multiple. It's really easy to calculate, and it's used by SaaS investors. And this is the idea here. So how much money did you burn to grow, right? And this is the what is expected. If you have under 1 is amazing, and if you have over 3 is really bad. Like you're burning a lot of money to grow, and great companies. Companies that, especially on SaaS, who are able to keep fundraising, they grow, but like they grow not burning that much cash, so they have a burn multiple between 1 and 1.5, something like that. Okay, okay. So basically, this is it. Those were the basic concepts of finance, and I hope that you guys got them, because now we're going to talk a little bit about tactic and how we use those concepts to avoid big mistakes in terms of finance for startups. I have to accelerate a little bit because of time, but let's do it. So, what is the main job of a decent CFO? So basically, not let the company run out of cash. Okay, that's the job. That's the job to be done. So what? So what you want is cash predictability. Basically, you want to know how your cash position will evolve over time. What do you need? You need a projected income statement. This is easy. Probably everyone has. It's like the projections. You also need projected operating working capital, projected CapEx, CapEx is basically when you buy machinery or you buy a plant. If your company is asset heavy, you spend that money under the capital expenditure account, and it's also booked on the balance sheet under PP&E. It's power plant and equipment. It's the fixed income, the fixed asset line on the balance sheet. So you also need that. And this is it. So basically, how do you do it? Your cash variation is your net income, which is the last line of your income statement on accrual basis, minus the variation of your operating working capital. So basically, how much you have on this month on operating working capital, minus how much you had on the previous month, minus the CapEx. So this is it. So this is really, really important. So if with this three information here, you'll be able to forecast how your cash will evolve over time. And obviously, this is very simplified. Probably if my bosses from Goldman Sachs saw me telling you guys this, they would fire me. But this is assuming several stuff, like no debt in the business, some other simplifications. But this, what is important here, is much better to consider this as cash variation than considering EBITDA or net income as a proxy. So this is much more precise, especially because this number here, the variation of operating working capital, is really significant usually. So that affects. Well, just to give you an example here, one of the companies that I used to be CFO in 2019, the founder said, "Well, I don't understand. I have a 700,000 loss per month, but my bank account is going down by 1.2 million every month. Oh, is someone stealing from me?" And then we went to check, and it was all explained by the variation of working capital. And we tried to optimize our operating working capital in order to try to minimize the burn. Okay, so this is something that's really important. And I hope that you guys understood the concept of operating working capital. So this is it. That's the most important job of the CFO. And this is how you do it, right? So you want to have cash predictability. To sum up here, to finalize, some real life examples and some procedures, some tactics that you guys, I strongly advise you guys to try to do, because it's a good way to start with the right foot in order to have like organized finance from the beginning, from the onset on your startup. So some real life examples. The idea here is that you cannot avoid the bad news, but you can avoid the bad surprise. So just for clarification, like this is bad news. This is bad surprise. Okay, so you guys understand the difference, right? So when you have bad news, you have time to prepare for it. When you have bad surprises, you don't have time to prepare for it. So basically, what I advise you guys here to keep things in order when you scale your business. Number one, keep track of your accounts payables and accounts receivables, especially at the end of months. This is an example here. So this company has a total accounts payables. So basically, this is stuff that the company already bought, but did not yet pay, of 2 million reais. And this is a schedule of how much it will be paid week by week over the following 5 weeks. Same for accounts receivables, right? So this information is very useful for you guys to calculate operating working capital. Number two, I think it's wise to send a daily KPI to email by C-level. It's really easily done and it's high value added. This is an example. This is a B2C company. So basically, accumulated revenue of the month, the revenue of the previous day, projection for the month, month-over-month variation, comparison to the same month of the last year, budget, and some marketing metrics, CAC especially, and the comparison to the target of CAC of that following month. That's something that is really quick, easy to be done. And then you get used to see the pulse of the operation, right? So this is something that I usually advise early stage companies to have this routine. It's people get used to seeing that email every day, and then they have a sense on how sales are going, how the operation is running. Weekly KPI with 5 weeks visibility. This is an example. It's basically the cash basis analysis. Okay, how much money we have, how much money will come in and go out of our bank account. This is full cash basis. I usually here I put 5 weeks, but I actually advise you guys to put like 15 weeks so that you guys have like more or less 4 months of forecast, like not forecast, but like real data of what's going to happen with your bank account based on the schedule of accounts payables and accounts receivables. Okay. Number 4, discuss projections with co-founders. It's really important to project the following 12 to 18 months. This is for both fundraising effort, but also for planning and to see how much money that you need, and forecast the cash variation and not only EBITDA or net income. So basically, this is the outcome of this talk. Like, if you are able to forecast your cash variation using your net income projections plus your operating working capital projections plus your capex projections, then you will be in a much better shape than some company who's only projecting an income statement and EBITDA or net income going forward. Okay. And then so this is an example of a projection of a cash flow. And then at the last line here, you can see how the cash position evolves over time. Okay. And finally, the final advice, beware of scaling your business before having clarity of your unit economics. Contribution margin is super important. You have to understand how it evolves over time before scaling your business. Okay. I know it's hard, but it's really harder if you don't do it. And it's really something that you cannot correct after the fact. And this is it, guys. I think I spend a little 5 minutes more, 6 minutes more, but like, if you have any questions, you can shoot me an email, LinkedIn or Instagram, and I'll be happy to answer your questions now.
This was amazing, Felipe. Thank you so much. There's a lot of homework and a lot of concepts to process, but this was just amazing. We will go through the Q&A. We've seen a lot of questions. I'm seeing some hands raised. We sent the link in the chat to make some questions. So if you haven't questions, you're still on time. Just send it through the link that we just sent in the chat. And also you can vote. So please vote for the questions that are more relevant for you. And well, I'll start with the first one that already has 8 votes. This one is from Sebastian Del. And his question is, what is the minimum runway that should be accepted in a startup? 5 months? And what is an acceptable burn ratio?
So I would probably need more info to better answer this, Sebastian, but like, I think that in terms of the current market, because it changes with the market, right? So nowadays, it's really important to have a minimum of 12 to 18 months of runway. We are currently advising our startups here of EquitasVC to extend their runway and sometimes sacrificing growth because of the fundraising scenario. So I would say that between 12 and 18 months. And in terms of burn ratio, well, figures be above 2.5, I think it's very worrisome because you'll be asked by your investors or potential investors if you really have a sustainable business model or not. And probably if they are asking that, it's because they think that you do not have it. So and nowadays the the minimum standards for fundraising, they have been increasing because of market conditions. So I would say above 2.5 would be really bad. And I would try to improve that before trying to fundraise or even before scaling up your business.
Amazing. Thank you, Felipe. The second question is from Stephanie, and her question is, what is a healthy debt to income ratio at pre-seed and seed stage? Does it change depending by industry, like consumer goods, SaaS, etc.?
It's really, well, at least here in Brazil, it's not very common for us to see startups in the pre-seed and seed stage with debt. It's really rare, and it's something of a bad sign, actually, because it shows you that you are probably not able to fundraise to fundraise with equity investors. Then you had to go to debt investors, and it also raises a question on your future investors, like what's the money going to be used for, right? Am I going to raise equity money to pay off the debt? And this is bad because the money that it will not go into the business to grow the business. It will only be used to repay the bank. For early stage companies, the debt to income ratio would be 0, right? So ideally you don't have any debt on your business. For later stage companies, just for the sake of clarity here, is usually the accepted. People usually look at a debt over EBITDA over debt over EBITDA ratio. So basically, that's the usual metric. And people, they start to be afraid of the company if the debt over EBITDA ratio is over 3 times, usually. So there are some loans, at least here in Brazil, as where I'm used to, and I know the environment where you have some covenants and mechanisms of repayment that they are triggered when your leverage, which means your debt over EBITDA ratio, goes above 3 times. So that's a company that's considered over levered or in a fragile financial situation. But like for startups, not very common for founders to raise debt in the earliest stages.
Thanks. The next question is from Raul Marquez, and his question is, what is a good lifetime value CAC ratio? And the second part, I think it's that when it should be like the moment in which you spend more in acquisition, and if it depends on the industry.
It's a very good question. So for VC standards, like the usual metric for LTV over CAC, the classical metric is 3 times. Okay, so basically you want to have 3 times your LTV 3 times higher than your CAC. I once had this exact question by an investor. I was acting as CFO of a company, and that company had a LTV over CAC ratio of 12 times. It was significantly better. And then the investor said, like, why are you not growing faster? Okay, but like it's not as simple as that, right? So because sometimes you have a specific niche where you are already big enough that you cannot invest more money. You're going only to have decreasing returns on your investments. Sometimes you don't have cash, like in terms of you don't want to risk that much. You actually don't know how your CAC is going to evolve. And it's not so obvious as the investor who asked us at the time thought. Like you have to understand the nature of the business. Maybe in a month you had like a good LTV over CAC because a competitor was in trouble and he didn't invest or compete with you in that given month, but that may change over time. So I really like, and this is also part of the contribution margin analysis, because the marketing expenditure is a variable cost. it's for us at least, like we love businesses who are like, when you see like things, figures like 6, 7, 8, 10 for LTV over CAC, you think like, wow, this is good enough, especially because investors, they tend to have like a security margin on that figure, because everyone calculates his or her CAC in his or her own way. So if you have 3, you may raise like a question mark in the investor's head, like, well, maybe it's not 3, maybe it's 1.5, and then it's really bad. Okay, so this is our mental model here. Classic literature says 3. We would go for something like 6, just to have some security margin in terms of analyzing a model that we want to make sure that it's sustainable over time.
Super interesting. Thank you so much. So the next question is from Carlos, and the question is, how do you get when your contribution margin is lower as your sales increase? Example, you buy your hosting infrastructure for a fixed price, but the margin gets lower as new customers use your app.
How do you get when your contribution margin is lower as your sales increase? I'm not sure I understood the question. Like, well, let me try to answer if I understood correctly. If Carlos wants to clarify, but like contribution margin, you ignore your fixed costs. Okay, so yes, you will spend more money if you buy a new hosting infrastructure, but remember, you'll be paying that hosting infrastructure, if I understood correctly, if you sell or not, right? So that's not a variable cost, that's a fixed cost. It's like rental or payroll. Okay, so that by considering it that way, it would not change your contribution margin. Okay, so it has no impact in your contribution margin. So given that example, your contribution margin will not go down if your sales increase. It will keep the same, all things equal. It will remain the same because your infrastructure cost here is fixed. So this is the beauty of the contribution margin. So you may justify the investment in infrastructure by saying, okay, if I grow my number of users by a big amount, I will have more money to dilute the fixed costs. Every business is like that, right? Every business, you have to differentiate what is fixed, which are the fixed costs and expenses, and which are the variable costs and expenses. The fixed costs are probably the ones who are going to hurt more in the beginning. However, the variable costs are the more important ones when you grow, because they will grow with your sales. So if you think about it, it's really in your best interest to control, especially your variable costs, because they will follow you and be becoming bigger as you grow. Okay, so Carlos, if you want to jump in, feel free. I hope that I answered your question.
Thank you so much, Felipe. And the next one, I think we'll be closing with this one. This one is from Carlos Lara. I personally love this question. I think all non-financial founders have made these questions in any part of their journey. And the question is, if you recommend to hire an account financial specialist for all these analyses, or should like founders go directly and do it themselves?
Well, accountant since the beginning. It's really important, at least here in Brazil. It's really important. This is a big problem. We see that very often in terms of startups that are, I don't know, raising a Series A, and they have they in the beginning they got the first accountant that someone referred them to, and then that guy did not work, and then you have a lot of rework and a lot of sometimes fines, and you have problems with the government because the taxes, they were not paid correctly. So in terms of accountant, I would go from the beginning. And I would like to highlight here, like, do not like try to get an accountant that already works for other early stage startups. Reach out to people on LinkedIn and say, like, do you have someone to indicate, like, some startup from your city, so that you can have the same accountant. Do not go with your mom's accountant, who's 65 years old and knows nothing about startups. That's probably a bad choice, and you're probably going to pay a high price for that mistake, and it's going to also be quite stressful. And also, the whole idea here in this talk is like to be able to focus founders on product sales, marketing, and doing the minimum to keep finance not being a problem. So hiring an accountant is one good strategy from the beginning. In terms of financial specialists, well, in terms of CFO, to be honest, I would probably only hire a CFO after a decent Series A, or previous to a Series B. I think a controller is cheaper, and it's more important in the beginning. However, a CFO is likely needed after a Series A in terms of establishing a relationship with potential investors, reporting, audit, and stuff like that, but probably not from the beginning. It's quite expensive, and it will be more useful in the later stages of the company.
Amazing. Thank you so much. I know we had some more questions, but our time is kind of over. We really encourage you to contact Felipe. He sent his contact details, and keep asking more valuable questions as these ones. And Felipe, thank you so much for being in this special opening night. This was amazing. We really appreciate all your time and all your knowledge. And for everyone that joined us, thank you so much for being in our first ever Latitude Night. Please join all the next Latitude Nights that we'll have. We're sending a link in which you can subscribe to see all the information of everything that it's like coming up next. And it was beautiful to have you all here. And Felipe, thank you again.
No, it's my pleasure. I really hope it was not too much for you guys in terms of concepts, but try my best to give you the basic stuff. And if you have any further questions, shoot me an email or message on LinkedIn. I'll answer gladly. I know it's really hard to build something from scratch. Really try to understand your business model in terms of contribution margin. It's really a pity when you see companies with, like, I know companies here in Brazil with like 500, 600 employees that did not yet figure their contribution margin model, and it's really sad. So I really hope that you guys do not make the same mistake. Build something of value, and thanks Latitude for having me. I hope it was useful for you guys.
It was super powerful and insightful. So thank you so much. And thank you everyone that joined. You're super welcome to all our next Latitude Nights. We hope you loved it, and we hope to see you soon too.